quick introduction, and as I go through this, feel free to jump in with any questions you might have. My name is Scott Eltjes. I'm from BTC Capital and Bankers Trust. Tell you a little bit about my background here, but before I start, it looks like Jennifer stepped out. I want to thank her. Full disclosure, these materials are from you and I. They've got some great curriculum. This is just a sample of what they have available on really all the investment basic topics. So really glad to be here. Hopefully provide something that's of help to you today. It's intended to be pretty basic, but I'm happy to answer any questions. Just throw them at me and I'll do my best. BTC Capital and Bankers Trust. A lot of people know us for our banking side. I run the investment and wealth management side. We've got offices in Des Moines, Cedar Rapids, Sioux Falls, South Dakota, and Scottsdale. So in aggregate, we run about $20 billion, 20 billion plus in assets for our clients. And I'm a UNI grad, full disclosure, UNI grad. I grew up in a small town in Iowa, Parkersburg. So born and raised here, got my undergrad at UNI in finance, and I've been very involved with UNI, just trying to help business school, education around the state, so just really glad to be here. I'm also a great grad, got my master's degree, and spent my career here in Des Moines. So with that, I'm going to get started. And again, just kind of, if we have time at the end, I think Jennifer has a little exercise that might be of help to you, but again, designed to be pretty basic, just to try to get, my perspective is I talk to a lot of students, a lot of student groups, our interns, new hires, things of that nature, and just really trying to get people to pique their interest in investing. And I think a lot of people think about saving and investing, and again, if this is too basic, just give me I'll move on. But I think for students and some of your audiences, to get them to think about the difference between saving and investing, saving short term, very liquid, usually emergency funds, day-to-day expenses, things of that nature. Everyone needs savings. A lot of people forget about the investing category, or they just never get started because it's a little bit intimidating, a little bit overwhelming. But again, investing, more long-term, less liquid, generally volatile. You've got some risk in there, but generally buying asset classes that people are not as familiar with. And I always tell, I have to remind my team members, like, hey, what we do is really mysterious to a lot of people. It can get really complicated. Our job is to break it down and make it simple so people get started. So again, just basic differences between saving and investing, pretty intuitive. I think sometimes it's hard for people to really get their head around, why should I invest? And it's investing is fun because you get a dream of things, right? You get to think about retirement, paying for college education, maybe vacation, or a vacation home, a small fishing boat you can see down in the lower corner there. But it's good because the reality is, if you start early and you invest appropriately, those things they kind of come into picture for people, and those are good goals. Those are common goals. It's kind of goals that we work with our clients to help them with their investments. Investing just without a goal or an objective is it's harder for people to see the value. But when you can attach a goal like that to investing, a lot of times it really helps. It helps make the picture more clear to them. What can I invest in? And again, pretty simplified chart here, but when you start thinking of the investing marketplace, generally it starts with pretty simply, stocks, bonds, commodities, gold, silver, things of that nature in the commodity category, properties, rental properties, homes, office complexes. You get into currencies. Everybody, has become much more familiar with cryptocurrencies. That's a class in and of itself. Happy to talk about that afterwards, but basic currencies and particularly cryptocurrencies have become a lot more in vogue in the last while. And so different asset classes. There's other things that aren't up there. Artwork, things of that nature. Just different asset classes, probably beyond the scope of today. But I think it's good for beginning investors to think about there are options. And the main thing is that we're going to get to here is the risk and return is very different for all of these asset classes. Very simply, and most of you are probably familiar with this, but I think when you're teaching someone about investments, really starting with what's the difference between a stock and a bond. And stocks, also known as equities, really just a share in ownership of a company. And they can take a lot of different forms, but at its basic form, just owning part of the company and participating in its success. And that's really what it boils down to. Bonds, really those are just loans to the company. Really just an agreement to lend money to a company for a specific period of time at a specific rate of return. And again, this is intended to be very high level, but I think the best thing we can do is start educating people on the difference between cash, stocks, and bonds. And then just to pique their interest. I was fortunate, I became really interested in investments at a pretty early age. And the thing that I've learned, investing, it's like anything, it takes practice. You get better over time. You got to start, you got to learn, you got to make some mistakes. But starting with the basic differences between a stock and a bond, I think is pretty important. We're in a period right now where bonds have become very attractive again to investors. A few years ago, not so much, because the yield wasn't very attractive. So bonds didn't get a lot of airtime. They're starting to get a lot more attention and traction today. A great place to start for investors is mutual funds. It's a broad category, but there's mutual funds, actively managed. We've got exchange traded funds, which are really a passive product, and we've got index funds, also passive. And I won't go into all the nuances here, but the great thing about these categories, particularly for beginning investors, they're a great way to get access to the market at very low cost, and you get professional management. So a lot of people are like, hey, I just don't know where to start. I want to invest, but I don't know where to start. Mutual funds, exchange traded funds, index funds, they're very easy to buy, very easy to sell, and you can get in with low minimums. I usually look at this as a continuum. I love seeing people start and getting used to just market movements so they can get a better understanding of their risk tolerance. And when they get the handle of that, I love seeing people experiment with individual securities. But it depends on their risk tolerance. This is a great place to get started, get access to the market, and to start building some knowledge and start building some assets to maybe invest differently over time. This chart just shows you, and it's very, very simplified, the difference in risk and return for different asset classes. And again, I can put a lot more up there, but if you look at the left axis, basically it shows you potential returns. So the higher up we go on the left axis is obviously higher returns. The farther we go out to the right, higher risk. So cash, low risk, low return. Bonds generally in the middle, a little higher risk, a little higher return. And then stocks, higher risk, higher return. I'm going to caveat with that one. This is very general. You can find bonds that are more volatile than stocks. It's beyond the scope of what we're going to talk about today, but again, for beginning investors, to get them to think about there's a trade-off between risk and return, how far out on the spectrum do they want to go? Most people really don't understand their risk tolerance until they've experienced the downside, and that's kind of how you learn. You learn the most when you lose money. You learn more than when you win money. So again, just risk and return, very basic. Cash, bonds, stocks. You move out on the spectrum. The hope is by taking more risk, you get more return. The other thing I want to convey to early investors or new investors is, picking a strategy. You don't have to just pick one thing. Asset allocation, and we've got a whole section on asset allocation. Asset allocation is really, really important. That's kind of what this slide speaks to. Asset allocation, in my mind, is just risk management. How much risk do you want to take? So, if you want to be a conservative, and this talks about establish your goals, establish a time horizon. Don't sell when the market moves. If the market goes down and it makes you nervous, maybe you shouldn't have been saving that money rather than investing that money. But the best thing for people to do is think, hey, am I conservative, moderate, or aggressive? If you don't know, pick one. Start someplace. How much risk do you think you can handle? Most people don't understand their risk tolerance until they've been investing for a few years. You got to go through some ups, you got to go through a few downs to really get an assessment of where you fall in the spectrum. I personally fall very far out on the aggressive spectrum. It's just, I get it and I'm okay with it. That's not for everyone. So if you're looking for a conservative mix, let's say you got a 5-year, 15-year time horizon, these are not precise. We'll just give you an example. 5 to 15 years, maybe you want 50% stocks, 50% bonds. If you've got a longer time horizon, you can see as you shift out to moderate and aggressive, the longer the time frame, the more aggressive you can be on paper. You still have to be able to tolerate it personally, but the more aggressive equates to a longer time horizon, and 90% stock, 10% bond allocation is going to be more volatile, which is why you want more time to be able to ride the ups and downs of the market. Diversify your investments, and again, we've got materials on most of these topics which can do a much deeper dive. But diversification, I mentioned it earlier. Diversification is all about risk management. The old adage, don't put all of your eggs in one basket. It certainly applies to investments. The more you diversify, the better you're able to get strong upside returns with less downside risk. And that's the goal. We're trying to find a trade-off between the risk and the return. Most people, when they invest, they think about the return side of the equation. I coach my team members and our clients. Our job is really risk management. If we do the risk management right, the returns will come. The worst thing you can do is focus solely on return and forget about diversification and risk management, because that's usually if you don't diversify, the concentrations generally will cause you some heartburn over time. So include investments that move in different directions. Basically, it's negative correlated. That's what we're looking for. Assets that don't move in perfect tandem. Again, that's risk management, offsets risk. When you diversify, you're more likely to have a winner, more likely to have a loser. They offset. And it protects you here, as I said, from severe losses. So diversification, really critical. There's a lot of different ways to do it across asset classes and within asset classes. Again, we won't do a deep dive on that today, but the one thing I can tell you, and I'm a little bit biased because I think UNI is a great school, I got a really good investment education at UNI. Brett and his team, they do a great job. I feel like I learned all of the basic fundamentals that I needed to learn to apply in my career. And the thing that I've learned too, investing can be as complicated as you want to make it. But I tell my teams all the time, blocking and tackling, keep it simple. Because if you get too far out of your skis, you're going to pay for it. But investing really isn't that difficult. It's really not that complicated. You just have to stick to the disciplines. This one I like. It's a slide that basically says, investing for the long term and what you invest in matters. So what does $20,000 look like in 30 years? All depends on how you invest it. So the first one, under the mattress. If you do nothing with it, $20,000 under your mattress, 30 years you're going to have $20,000. You put it in a savings account. And this shows 3%. It shows 2%. Finally, we're getting about 2% on savings, right? Finally. So, but again, 2%, your 20 grand grows to $36,000 after 30 years. Is that good? I don't know. Depends on the individual and what they're saving for, what their goal is. And then you've got investing, and this is showing not quite a 6% annualized return, which, to be quite honest with you, is relatively, it's a relatively conservative growth rate. But you can see where that then accumulates dramatically over time as compared to the other investments. So, can 20 grand grow to $100,000? Sure, it can, easily. And in fact, with 5.5% rate of return, that's still very conservative. Double that return, and that number gets dramatically larger. I'm going to give you an example here of two case studies that I think are just really important. And sometimes just a couple of real life examples that I think can help new investors really see the power of investing and the risk of market timing. So, Ronald Wayne, co-founder of Apple. You don't really hear much about Ronald Wayne when they talk about Apple, right? So I love this story. Ronald Wayne was co-founder of Apple, early investor, sold his stocks for $800 in 1976. Probably needed the $800, right? Today it'd be worth $35 billion. So that was a bad trade. Bad trade. Does anybody know what Ronald Wayne is doing today? I don't either. I don't know. So that was a bad trade. Walt Disney gave his housekeeper stock every year for Christmas. Very nice gesture. Turned into $9.5 million by the time she passed away in 1994. So I'm sure I'm preaching to the choir. I don't know the level of investment knowledge in the crowd, but I know you know the power of equities. If you can harness the risk in equities, it's a game changer. And if you can learn to fight the risk, you don't want to be around the lane, right? I mean, when the market gets tough, a year ago, everybody wanted out of the stock market. You know, we go down 30 to 40%, people panic. That's the best time to buy. So you look at versus a year ago, there's been so much money made in markets, and you don't hear about it on the news. When the news is quiet, that's when we're making money in markets. When the news is loud about what the market's doing, that's when you got to start getting a little bit cautious, right? Warm up to be greedy when others are fearful, be fearful when others are greedy. It's true. Ronald Wayne was a bad trade. I love that slide. Starting and managing your money. So if you're a beginning investor, and there's probably never been a better time to be a new investor, because the product availability and access to information is so good. I taught an investment class last year at UNI, and it was amazing to me to see the access and the knowledge that the students had about all of this that I didn't have when I was at 8, because they have this. But I told them, like, you got to get really good at deciding what's a good source of information and what's a bad source of information. Brett Olson later is going to talk about financial apps, and I know he's got a great list of if you want to use it for personal use or for in your classrooms. There are so many apps out there, and most of them are good, some of them are not. So it's a little bit buyer beware, but this slide will show you, again, there's so many ways to access the market now. When I started investing, you could do a full service broker, and they were expensive and you needed a lot of money. So to get access to the markets was difficult. It's easy now. So you can do a full service investment provider, and we've listed a few there. You can do an online discount broker, and there's a lot of them, and the great thing is you can start with very little money now. Trades are free, even though they're not free, but they feel free, and they're pretty close to free. And then there's robo-advisors, and if you just want to provide money and not make any of the decisions, there's algorithms that will manage the money for you. So, access to the markets is really easy now. It's relatively inexpensive. I talked about mutual funds, index funds, things of that nature. If you want to do individual securities or you want to do funds, it's really easy to access now. And it used to not be. It used to be very expensive. I remember trades were $175 a trade. And now you can do them on Robinhood for free, right? So at $175 a trade each way, $350 on a round trip, you really had to have conviction to what you're buying. It's pretty easy to trade today. Rules for beginning investors, and I'm sure these materials are available or will be available if you'd like to see them or have them. The rules for beginning investors, again, blocking and tackling. You got to keep it simple. Keep it simple, keep it low cost. They can get fancier as they get more experience. But the thing that I see a lot of times, people they get started on the wrong path, they make a mistake, they lose some money, and then they're done. And I just tell people, keep it simple, keep it low cost, take small bites, get some education. Don't try to time the market. Don't be around a wing, right? You don't want to be that guy. Dollar cost averaging, sure many of you know that concept. If you're either in IFRS 403B, you've ever been in a 401k plan, they are built around the concept of dollar cost averaging. That is the best way to accumulate wealth and beat the market. That's just if you can have the discipline, whether it's in a retirement vehicle or outside through a mutual fund, monthly withdrawal from your paycheck or your checking account into a fund, and just set it and forget it. I guarantee, I tell people all the time, get a 401k plan, get your company retirement plan, get into IFRS, you'll be glad you did, because over time, that's the best way to accumulate wealth. Dollar cost averaging works, and it's basically just putting in a fixed amount each month into an investment vehicle. Rebalance, some people like to rebalance once or more a year, and that's basically just realigning your asset allocation. Some do, some don't, but I think to get into the discipline of once or twice a year really paying attention to what happened in your account, should you make adjustments or not. The one thing I would tell you is I think 4 is pushing it. I favor fewer rebalances more than more, and if you rebalance too often, you're really going to dilute your returns. The caption to the right where it says investment performance is more about time in the market than timing the market, that's the truth. When you get, like last year, you get a big downdraft in the market, it's human nature to think that you're going to time it. I'm getting out now because it's gotten really kind of rough, and I'm going to get back in before. It hardly works. I've been doing this for 35 years. Market timing both ways, knowing when to get out and when to get back in. Most people get one of those wrong. Mm-hmm. It's hard to do both because the market can move so fast. When the market recovers like it did this year, it'll move so fast unless you're at your desk every day doing it like me. That's what I do for a living, and you see it. But if you can miss a week and miss a lot, and we've got tons of stats on that. I'm sure you've seen some of them. But it's really important. This is blocking and tackling. Dollar cost averaging. Don't try to time the market. You might get part of it right once in a while, but you're usually not going to. You're going to miss something. So I think that's really important. It says be aggressive. Be aggressive. Use aggressive as your time horizon and your personal risk tolerance allows. But if you're talking to students, the best thing that they have is time. Right? They got plenty of time to build wealth. And it does make a difference. Starting early, it makes a dramatic difference. Don't chase returns. Usually I call it the flavor of the month or the flavor of the day. If they're talking about it on CNBC that it's the hottest thing, it's probably too late, right? Sometimes you can get involved in a momentum trade and it's kind of fun, but if they're talking about it on the news, it's probably too late. It's getting close. It may not be done, but it's getting close. So a big mistake that people make is they chase the hottest thing. It's like, what's everybody talking about? I'm going to chase it. GameStop, right? Some people made some good money on GameStop. Most people lost a lot of money on GameStop. So, any questions? Yeah.
More of a comment to go with it, but yeah. I had one student in class that when the GameStop thing did what it did, he had enough money where he bought himself a Tesla when he was done. Nice. Same kid. Same class, another kid is the same thing, puts the same amount of money in. That kid lost $800. It was like, so I was like, perfect. I was like, this is a beautiful example of market timing. Did all of your parents understand what you guys were doing? And they were like, yes, they allowed me to do it. Yep. One learned a really valuable lesson, and the other kid was like, who got the Tesla out of the whole thing, says, I've also lost a lot of money since then because I got really caught up in what I thought that I was going to be able to do that all the time. So he's like, I realize now, and I thought that was great because everyone always talks about that one kid and he did that one thing. Right. I was like, and he got super lucky.
Yeah, you know, and that's the interesting part. I'm glad you brought that up. So we were in a period, pandemic, post-pandemic. It was a perfect storm. A lot of people had free money, they had money. They had time, they had nothing else to do, and we got into a momentum phase, and that's what I'm talking about momentum. Sometimes you can get in the groove at the right time, and you can ride it, and their story, my son and his buddies, like, we've got both of those stories too. kids that make a ton of money, like, you gotta be kidding me, you made that much money. Be careful, it's time to pull the plug. As a dad, I had to say that a lot, right? And then you see kids like, he was doing so well, one of my son's buddies doing so well, dad decided to give him his money. And he made a lot of money for himself. He blew up his dad and mom. And it's like, so I see the horse, so that, you know, but the thing is, that's the beauty of the market, that's why I love it. And there's so much opportunity for good results and bad results. And sometimes you get lucky, and both of those students learn something, right?
Yeah.
They probably both learned it's not easy. One got lucky and probably and did the right thing, probably did all the right research and got in the right groove. But those grooves, the really good grooves in. But that's great perspective. A lot of money was made in that environment, and that environment's gone now, and we're back to something else. But we're in a new environment now where quality matters rather than the meme stocks. So, and that's the other, and it's not addressed in here, but the market will move from one thing to the next thing so fast. Meme stocks, crypto, momentum, all of that. That was fun and it was awesome, but that's kind of old news right now. We'll move to something else. Doesn't mean it won't come back. Thanks for saying that. And if you guys have any questions on that or anything that I've covered, yeah, question.
Yes, I'm a little nervous about investments, but I'm just out of curiosity. Well, two questions actually. So let's say if I invested $1,000 and it goes bad, and I only lost $1,000, or do I actually lose more than 1,000?
Great question. That's a great question. Depends. So start with, and it's not in here, don't use margin, because that's how you can lose more than your investment. And I won't go into deep details on that, but most of what I'm talking about, you buy an individual stock or a bond or a mutual fund, and you make a straight purchase, your maximum loss is your investment amount. If you buy on margin, the dynamics change. So, if this is for you or for your students, when my son started trading, I'd send him, and they were just like, hey, don't do anything without talking to me first. And that lasted like 6 days. And then I found out, it's like, you did what? And, you know, he learned a lesson. But it's like, hey, learn your lesson, but write down your rules. Write down your trading rules. What will you do, what won't you do? And I remember sending him a text one day, and I still got it. What is the one thing that you will never do? Because he's trading, you know, all his kids are trade options, like and what is the one thing you will never do? And it had to do with writing naked calls and, you know, option-based, margin-based trading. And he still follows that rule because it's worried. So, if you're doing any investing and they're talking about margin, options, don't go there yet. That's an advanced class. You can make money if you're right. You can lose a lot if you're wrong, depending on the structure of the trade. I don't know if that helps.
Yes, it does. And my second question is, we all get our paychecks, you know. I'm just curious, how does investments work when we get paychecks?
Do you, and I'm going to ask, do you have the ability to withhold from your check monthly? Probably. I would guess. Like for a retirement plan?
Probably a 403.
403B, right? Yep.
Yeah, at my school they take money out for IFRS. Yeah.
You do, okay. If you have the ability to take your own money out for a 403B, generally, yes, you can withdraw it once a month, generally, and put it into an equity fund or mutual fund, something of that nature. It really boils down, and if you're not sure, talk to your human resources person at your school. Everyone's probably a little bit different. But what I'd say is if you don't have it through your employer, you can set one up separately by yourself. You can just buy a mutual fund monthly.
Roths are really good for teachers.
Yeah, Roths are great. You want to talk about that? We got, Roth IRAs are a great option. And I'm hedging a little bit because I don't know what you all have. I think everybody's got little different tools in the toolboxes. IPERS, Roth IRA, 403B, on the corporate side it's a 401k. So if you're not sure what's available, definitely go back to work and ask.
So,
Go ahead.
sorry. It's amazing how far this has come from when I was in high school. And probably like when you have students coming up to you that know more than you ever knew, it's crazy. And I will have students that come up and they want my advice. So I need an opinion. We work, for my finance class, I'll bring in a financial advisor or someone from a bank, and we'll talk about investing, and we show the Dave Ramsey video, $100 a month for 40 years, and it gets them all excited, right? But I've had students come to me and say, I have $1,000, and I hear about the fees that are charged from financial advisors, and I worry about that for them.
Yep.
And we talked about an S&P 500 index, like a Vanguard. I don't know if is it the right. It's their money, and I don't tell them I never tell them what to do with their money. I want them to investigate it. I want to provide some framework for them. Does it make sense for someone their age to do a self-managed index fund with $1,000? Like, look, if you had a grandchild, you were out of the game, you didn't have any connections. Grandchild, whatever, and they came to you and said something like that, what would you recommend to them?
For me, it starts with what level of interest do they have, right? And how hard are they going to work at it? Because, like when I was teaching the class at you and I was impressed by what they had on their phone and the knowledge that they had, right? But it was also impressive when I asked, hey, how did COVID pandemic? Because a lot of them got the checks. How did that work for you? I had some just really interesting stories. Some made a little money, some lost it all, so I think the ability and the desire to learn more about the market. Where I start with people is like, I think a lot of people have the interest in it, but I'm so worried about when they start trading individual stocks or options. And the kids right now with options, they're trading options. You shouldn't start with options. In fact, I think they should start with mutual funds, index funds, ETFs, to understand markets move and how do I feel about it, right? How do I feel about down 20%? I just lost $200. How do I feel about that? But the sexy thing is, tell everybody I'm trading options on Robinhood. I just made 38% last night, right? So I'm old school. I think you got to learn to block and tackle. You got to crawl before you run, right? So it's a tough thing to answer. I believe that if they start on the wrong spot and they make a mistake, they'll never come back as an investor. So I believe start as simply as they can, learn the basics, and then grow into it. Now I say that, I couldn't get my son to, they start on full steam and then they get whacked a couple times and they're like, oh, maybe dad knows something. So you guys are in a tough spot. I think put the tools in front of them and then caution them about taking too much risk before they really understand it. I don't know if that helps. You and then we'll come back to
Just on your point about full steam ahead, and I've had students like that too, but they're few and far between. Most students have no clue what to do with $1,000 and where to put it. So, yeah, go the conservative route for those kids, like you're saying, like what they're interested in and all that kind of stuff. That they don't know. So, do something safe and something long term.
And you might have the one slide I talked about ETFs. You might have students like, hey, I would really love. They'll come to you with a technology stock. Instead of buying the one technology stock, send them to like QQQ or a specific ETF index that will track a broader market so they can get exposure to it. That sometimes works. It's a tough one. I've never seen experienced investors with so much access, and it's great, but it's dangerous. So I'm old school. I want them to learn the basics before they go out and make a mistake. Because again, my point is, I see too many investors, they don't know what they're doing. They make the mistake and they never come back. And that's not the goal here. The goal is to get them to learn. It's just like what you're teaching in your classrooms. Teach basic building blocks, and I still learn every day. But I was fortunate enough to learn the building blocks first. You had a question?
Yeah, so you said it, talked about savings bonds, so like when my parents had me, they invested in a bunch of savings bonds and that's what helped me pay for college.
Yeah.
You said that is coming back, as when I had my daughter a couple of years ago, they were not enticing at all.
Right. So bonds is a category, whether it's savings bonds to government agencies, munis, corporate bonds, high yield. There's a million different varieties. Savings bonds used to be what I call dead money. I mean, you just don't get paid anything. So with what's been going on in the economy lately, yield curve has changed a lot. All of a sudden, short money and conservative investments are getting paid something. Banks are starting to pay on deposits, the CD rates, and so savings bonds. So there's a series of I bonds. Last year, you get 9% on a series of I bonds, government backed. That's, I think, probably down to like 5 or 6 now. It's changed. But you can go to the government treasury.gov and you can check all the different versions of government savings bonds, and they'll give you the rates. And that's so what was not attractive 2 years ago. If you want to be a conservative investor, government backed, kind of CD or treasury, kind of, yeah, they're a good option. They're a good option. But they're a conservative option. But it might be a stepping stone, a good starting point for people to kind of think about. I think it makes a lot of sense in a portfolio. Any other questions? I'm just going to point out a couple things here. So, how many of you know the Rule 72? Awesome. That's awesome. So I don't even need to talk about it, or so the Rule 72. I mean, that is a rule that I follow all the time. And remember, I got teams that do this for a living, and I remind them because, and I think it's really important for students to think about, why are you even doing this? Back here, it's like, why are you even doing this? What do you want to do? You want bragging rights? Trying to turn it into a Tesla? What are you trying to do here? But I think it's really important for particularly students to think about, how long is it going to take you? I asked the class the other night, how long is it going to take you to double your money? And you should have heard the questions like that. They were missing the point. It's like, well, it depends on the return, right? And it's like, okay, so the Rule 72 is basically, how long does it take to double your money? Take your rate of return, divide that into 72, and that's your answer. So 72, if you get 3%, 72 divided by 3, that's 24 years. And I think that resonates with students like, 24 years to double my money? I can do that on Robinhood overnight if I pick the right options rate, right? So I think you tell them it's like long-term investing, not fun money. And you ask, is this fun money or is this college money? And you started to get them thinking about what's that bucket of money for? It's for fun, it's bragging rights, or now I need this $1,000 probably to pay my first semester of help with the room and board. So get them to think about what's the purpose of that money. And I always like to get people to think about what's it going to take to double. So if you get a 3% or a 4% or a 6%, so if you're at 3%, it takes you 24 years to double your money. Gosh, that seems like a long time. Maybe I should be looking at 6% or more. If it's 6%, it's 12 years, right? If it's 12%, it's 6 years. And I just think that is all the tools and tricks and things that I've seen in my business over the years. Rule 72 is so powerful, and I think it's just something, if you can get it to stick in their head, it makes them think about risk and return without them really thinking about it. It's like, oh, I didn't realize that the difference between 3% and 6% can have that dramatic impact. The reality is, if you want that little fishing boat or you want the vacation home or whatever, you got to think about how long is it going to take you to get there. So that's where I think it helps cement the idea of risk and return. Where do you want to be on the spectrum? Is 3% on a bank CD, is that good enough? Well, it's not great when inflation's running at 5 to 8%, right? And we talk about risk, and that's another session, but when people think risk, they think of risk of loss of their investment, right? There's other risks, inflation risk, things, purchasing power, that kind of stuff. So rule 72, 72 divided by your rate of return, that's approximately how many years it's going to take to double your money. And I think that's that's one of my favorites. Stock splits. We talk about apps, and I'm all about investment education. And I'm not really talking. There's a lot of great trading apps, but I want people to get educated before they actually trade. And so, at full disclosure, StockTwits is near and dear to my heart. It's a New York-based company. I call it it's the Twitter for stock investors. So it's social media, it's investment education, which I think is important for students, and it's got a trading platform. But I think the most important thing, it's a community. So younger investors, they love communicating on these to their friends and their communities, people they don't even know. But the thing that I love about it's a community that's designed for investment education for people who have varying degrees of education. If you have none, there's a community for that. If you want to follow a leading investor, somebody who's really good at trading options or energy stocks, there's a group for that. And then they've got a trading platform. And this isn't a pitch, full disclosure. My son helped design that program, and it's pretty cool. It's predominantly education. So I got no skin in the game other than when he started on his journey, it's like, hey, you've got to get educated on the topic. And that turned into, for him, it's like, how do I educate others? And so I think the best service you can do for your students is help them get educated. And Brett's going to talk, there's Robinhood, SoFi. Robinhood started to do some education, TD Ameritrade. Everybody's doing it. Charles Schwab, they're all great. Let's see, do your research, talk about this a little bit, learn from what worked, more importantly, learn from what didn't work, learn from your mistakes. The best education I've ever gotten is when I've lost a lot of money. Because it's like anything, practicing sports, in your golf shot, your free throw, an instrument you play. The more practice, the better you get. I'm way better at investing now than I was 10 years ago. It's just you learn things. So I think the best thing you can do is if you've got a student or someone that you know they invested and it didn't work, tell them to break it down. Why didn't it work? It didn't work because maybe you didn't do enough research. Maybe you missed a piece of information, right? So I think if you can encourage them, learn from what worked, learn from what didn't work. Understanding risk tolerance is critical, and that's also, it evolves over time. Some people know their risk tolerance, some people don't, and usually risk tolerance ebbs and flows over time. But I think the best thing that an investor can do, make some mistakes, because that helps you understand what your risk tolerance really is. Some people can handle 50% down, some people can't handle 5% down. And there's no right answer, it's just whatever's right for you and for the individual. It is lifelong learning. As educators, I know you get this, but I say it's like this business is about if you love reading, studying, I love studying the market. I think the best thing, the most successful investors are students of the market. You just want to know what's going on, staying current. The one thing that you made me think of, I don't give advice on stocks anymore. People are like, hey, what are the top 3 stocks that I should look at? And you'll probably get questions like that. And the thing that I've learned, I've learned it's like, even if you believe today that XYZ is the best, you need to buy it. Guess what? That changes tomorrow. You don't know what their earnings release is, you don't know what kind of scandal, and then you see that person 6 months later, hey, I bought XYZ, that was it. Well, you can't buy it and think it's going to be good forever, right? Things change too fast. So lifelong learning, really important in investing, and then I think it should be fun. And I think it's really fun. I think it's an intriguing industry, career, and I enjoy it. I'm glad that you and I asked me to be here today. Happy to help. I've always tried to be really involved in education in Iowa. I've been pretty involved with Dollars for Scholars over the years and pretty involved with UNI. So if you have any questions, you need materials, you need some help, don't shy about reaching out to me. I'd be happy to help you how I can. So any questions on anything we covered? I know it was pretty basic, but hopefully there were some nuggets in there that might help you.
How would you define the difference between index funds and ETFs? I probably thought they were
They're very, very similar, and we're gonna get in the weeds a little bit. So where they start, where they're similar, is they're low cost, and they generally give you access to a specific part of the market, and they're passively invested. So you don't have some professional manager out there doing buys and sells. An index fund, the difference between a mutual fund and an ETF is really, for me, you can get about the same exposure. You want to be technology only, or you want to be S&P 500. They're very, very similar if you want to take a targeted approach to a specific part of the market and have it be passively managed, although caveat that with there's some ETFs that are not going active. But the primary difference to me is how they trade. So a mutual fund, you can buy it, but you get the closing price at the end of the day. You get one price. ETF, you can trade it all day long like it's a stock. And I can get a price now, and I can get a price in 3 minutes, and it's different. So they're very similar. The thing that I like about both of them, access to the market, it's inexpensive, professionally managed, or even actually passively managed in those two. But they trade differently. So if you want to trade it throughout the day, like a stock, you want an ETF. If you're comfortable with just getting the day-end closing value, which most retirement plans are structured that way, that's the primary difference to me.
Thank you.
Okay. Any other questions? I hope it wasn't too basic. Question?
Are you aware, I'm sure you're aware of, like Investopedia, is it similar to StockTwits? What are the?
Yeah, Investopedia is really, I like that. So, as I said, there's so many good services that Brett's going to have a really good comprehensive list for you. I've seen his list, it's really good. The only reason I mentioned that was kind of near and dear to my heart, because what I saw it do for, at least for my son and his friends, they went from wild options flippers to trying to get educated. Investopedia is really good. I like it. Yeah, I like all that. There were several listed on here: SoFi, Betterment, Investigate. Everybody. The thing that I like in the industry, it used to be, how do I get your trade and charge you for the trade? It all used to be about how do I make money on the trade. I think what the most providers in our industry now have figured out is like education is the key. And that's what I love about the trend in the industry. Education is key. There's a million great apps and services out there, and they're really, the quality of the education has gotten really good. Jennifer, did you have questions for me, or I think do we have time for?
Wait, does this session go to
It's
1:55?
supposed to be 2 o'clock.
To 2? Okay. So, yeah, we have like a little activity we can do.
Yeah, go ahead.
Okay.
Go ahead.
So just to give you an idea of something you can do with your students to help them learn about the different types of investment tools and the risk involved, we're going to do an activity. So you're going to be the students. So you're going to do what you're going to have your students do. So I need you to get into groups. So if you guys can get together in a group here, and like you want to turn around here. I just have 5 envelopes, so I gotta. And let's see if we can get, like if you guys can get together here. There you go. And then we'll split you guys up here. Somehow. Do you mind scooting over with these guys?
I don't mind at all. Yeah, I was about to say I was scoot over with these folks.
Okay. Or if you want to do your own group, you can do your own group. Whatever you want to do. Okay, so when you open up your envelope,
I have no idea.
okay, you see the different types of investments? You're going to list them from the least risk to the highest risk.
Okay. All right.
And we're going to compare the groups if we have time.
Least up your needs.
I think
Towards the cup is least risk.
Yes.
Okay.
Yes.
Yeah, we could be like my student. How did you cut this? Pretty low.
No, that's not being.
Yeah, I was gonna say.
Sorry, I also was I was always told that collectibles was the highest. It's, I think this is like more risky because you don't really know.
Oh, no.
Jennifer,
Let's say things.
Yeah, right. What kind of collector is it?
Yeah, like
Have you seen the practice?
What's that? Currencies like crypto. Oh. Let's do, yeah, we are the same thing. So think of currencies like crypto.
yeah.
Okay.
And these are high risk.
Yeah.
They're high risk because you don't know. Like Beanie Babies and stuff. Like Beanie Babies cars, painting, art. Yeah. And it's only worth when someone's really bad. Yeah. So don't. Yeah.
They're trying to regulate.
But it's
Okay, one more minute to decide. One more minute.
yes.
Are you guys done? You decided?
With slots, you can diversify. It's both. All of the above. Well, in my classroom, I switch how I coach people. Or you can always right. Yeah, and this is typical. I've done that before too. You're spending way more.
All right, let's go. Let's go. Okay, we're going to have each of the groups, each of your groups have pick a spokesman. So a spokesman for your group. And we're going to share out what did you choose as the riskiest? What has the most risk?
We said currencies, assuming they were cryptocurrencies.
Okay, what did you guys choose?
We had stocks.
Okay,
We chose currencies for the riskies.
okay.
We also had currencies.
Currencies, okay, so we had,
We didn't consider cryptocurrency though, and that's
I know, I
it's
didn't
like as soon as you
I
said
think
that,
I
like,
told
oh
you
no,
that.
that's.
Okay, all right. So what do you have next? Is the next with the most risk?
we said real estate.
Real estate.
Real estate?
Is that collector?
Collectibles, this is what we're gonna see, okay.
Collectibles. Yeah, we do say collectibles.
Okay. Okay. Any comments?
Yeah. What do you got now?
What do you all have for the least riskiest or the
Money market?
One more.
okay?
CDs.
CDs.
CD.
Yeah, we have CDs.
Money market.
And back,
We have CDs.
CDs, okay. So, between the two, which is considered?
On the most, on the least. So all of these, I think we've got them right directionally. But then it kind of gets into the underlying security. So CD, and I like to say, there's no perfect vehicle. So CD, you've got the guarantee of the bank, but you've got the risk of that bank, right? In a money market fund, you've got diversification, but you've got the risk of those underlying securities. So you've got to know what's beneath it. So to me, it's like whatever I buy, what's behind it, what's backing it. So then you go to like the crypto. I agree with you on crypto's the most aggressive, the highest risk because there's no backing of any kind behind any of it. So, but on the most conservative money market CDs, very comparable. Their yields will be the same, and depends on the size of your investment. CD, if you're below 250, you've got FDIC backing, right? Money market, you don't, but you got backing of the hundreds of companies that the securities hold within it. So very comparable, but it's apples and oranges in terms of risk, but they're very similar. It's just different risk.
Okay, so, yeah, go ahead.
So at Meridian, I have a money market account.
Yeah, good.
So is that still backed by NC?
Just have to see what kind of structure it is.
Okay.
So a money market, you know, and I'll put it in the banking world because I know that better than the credit union world. But a bank money market is generally not FDIC insured. You just got to check, got to have it. So you can have a bank CD, but a money market, most banks don't offer their own money markets. They're kind of packaging someone else's. So money markets are usually not covered by FDIC. But their risk is very similar. They're just different.
Okay, so an example of an activity you could do real quick with your students. You can see that I don't think any of the lists are the same that we have here. Yeah.
We'd like to know where real estate falls on your opinion, like especially when you gave that grid of the graph too, and kind of.
So I'm going to start with it depends, but to me personally, I think I look at real estate being a little bit more risk than stocks, mainly from a liquidity standpoint. They're less liquid, but then you get into the real estate category, and you can buy a rental property that's got pretty consistent cash flow versus an office building where we know we have vacancies right now. So when you get into the category, generally they would place real estate as a little bit more risk. When you just look at a simplified chart, real estate will generally be a little bit further out on the risk spectrum than a stock. But then it depends on stock A versus property B. And that's where you kind of get into finer detail, but generally a little bit higher risk.
I have a question.
What kind of investment is Shark Tank?
Is what?
What kind of investment is Shark Tank?
Oh, that's venture capital. Venture capital is great. It's a great show. Higher risk.
I have a feeling you might.
At the bottom?
At the very bottom end, below
It's far right. Venture capital will be a little bit better than crypto as far as I'm concerned, but we can take that. That's a good question.
Yeah. All right. Thank you, everybody.
Thank you, guys.
I'm glad you got it. So hard to get
So he said on Monday night.
Exactly. But it was close. Yeah, no way. Oh, I'm sure it was very relevant.
And so